Hello, everybody.
Hello, guys.
Hello.
Hi.
Hello.
Okay,
Hello,
let's
guys.
start our presentation. Good luck for you. Okay, the first performer is first performer will be me. My name is Gangirtin Mohkira, and I will start. I will present the first part of our presentation. Next slide, please. Okay, let's start our presentation. I'm gonna show you. I'm gonna present the first part of the presentation, our presentation, and we are analyzing the financial ratios of two companies. One is alpha and one is beta, and our reports will provide a perceptive assessment of financial standing and investment potential of these two companies. And due to fast modern changes, the company's financial landscape still evolving is most important for all companies, and all investors and stakeholders and decision makers must health situation. And okay, let's think about the financial health of the business or company. What is it? It's just simply if we are explaining it a simple way, it's just to pay bills on time and maintain the good business credit. As a result of these metrics, we can comprehensively understand the company's financial strength and ability to thrive in an ever-changing environment. We hope to assist stakeholders in decision-making informed investment decisions by providing insights into which companies would be the best investments for those seeking to invest their resources effectively. Now we will show our vertical analysis of income statement in this table, and let's see the main theory of income statement of vertical analysis. It would be income statement vertical analysis equals to income statement item divided into total base figure of income statement, and we should multiply it 100. That's the main theory. And now this table is showing us the two companies, alpha and betas, main income statement, and it's ended June 2023. In this table, we can see that company A, Alpha, generated a total sales of $770,000 with operating expenses amounting will be $46,000, resulting in a net profit after tax is $162,200. And on the other hand, company Beta had a total sales of $880,000 and operating expenses of $43,100, leading to a net profit after tax will be $210,400. Sorry. According to these figures, indicates that company Beta shows more effectiveness and resulting is a better overall profitability. But let's see, after all of the analysis, what's the final result? Alongside other qualitative aspects to gain a comprehensive understanding of each company's financial health. Okay, thank you. Now our next group member will present the next part of our presentation.
Hi guys, my name is Batsari Kambal in Team 7. In this section, I'm talking about the balance sheet. In our team did vertical analysis in balance sheet of two different company, Alpha and Beta. The vertical analysis aids in identifying financial trends by providing a clear understanding of the proportion of each line item on financial statement. After doing vertical analysis, we can see that Alpha and Beta companies' proportion of property, plant, and equipment are 65% and 56%, which is occupy largest proportion of the assets. And for liability and equity and share capital of both companies occupy the largest proportion of the asset. Vertical analysis financial statement in which each item is compared with its base amount and percentage. Can you go through the next slide, please? In this line chart, we compared each items of balance sheet of Alpha and Beta companies. As you can see, that chart is comparing cash and account receivable and merchandise inventory and prepared expense, property and equipment, and prepaid expenses of the both companies are similar and with minor difference. For cash difference between two companies are 14,500. Accounts receivable of the Alpha company 46,500 versus account receivables of the Beta company is 64,600. For merchandise inventory balance of the Beta company 48,060, more than balance of the Alpha company. The Beta company's balance of the property, plant, and equipment is 14,200, more than balance of the Alpha company. Comparing the total assets of the companies, Beta company has 97,010 more assets than Alpha company. Please, next slide. Go through the next slide. Okay, that's a line chart for liability and equity. This chart is comparing current liabilities, notes payable, share capital, and retained earnings. For current liabilities of Beta company, balance is 31,660 more than Alpha company. Not payable balance of Beta company is more than Alpha company. For share capital balance of Beta companies, 26,000 more than Alpha company. Returned earnings of Beta companies 18,950 more than Alpha company. Comparing the total liabilities and equity of two companies, Beta has 97,010 more assets than Alpha company. In overall, Beta company has more assets and liability and equity than Alpha company.
Thank you, guys. In the next section, I will explaining the financial ratios of Alpha and Beta companies calculated based on company's balance sheet and income statement. The 5 important categories in analysis are liquidity ratio and solvency ratio, expenses, profitability, and market perspective. I'm gonna discuss liquidity ratio, solvency ratio, and these are balance sheet metrics that measure the both company ability to its long-term and short-term obligations. Let's see the two companies' ratios. Okay, and from current ratio, Alpha and Beta companies have ratio greater than 1, both at 2.53 and 2.55. Yeah, that's correct. Its mean is 2 to 1. The current ratio measure is company's ability to pay its current and short-term liabilities with short-term and short-term assets such as cash and inventory and receivable So two companies can pay off their current and short-term liabilities more than once, indicating that they are good financial shapes. The next one is the quick ratio is calculated by dividing a company's most liquid assets, cash and cash equivalents, marketable securities, and accounts receivable by total current liabilities. Those both alpha and beta companies shows the accepted standard ratio of 1:1, and alpha speed ratio is 1.08, while beta company is 1.06. Both companies can maintain their financial stability and pay over their short-term liabilities without selling their long-term assets. Therefore, both alpha and beta company shows high liquidity ratio positions, and their current and quick ratios indicated that they can meet and their short-term financial obligations without selling long-term assets. Okay, next page. Next ratio is solvency ratio. It means a previous presentation on difference between liquidity ratio and solvency ratio. That liquidity generally refers to short term. So that's the ability of the company to meet its short-term obligations. And solvency ratio, we're gonna discussing the three metrics, or that's measure the company's ability to meet its long-term obligations, and reason why it's important for that solvency ratios long-term measures of the financial well-being assessing. And the two companies' solvency ratio is valuable measure of its financial well-being, assessing company's ability to meet its long-term debits obligations. The debit ratio of alpha and beta companies 0.32 and 0.36 respectively. This suggests that both firms can meet their obligations by selling assets if necessary. In particular, beta company shows greater than financial flexibility than alpha. Beta's company's debt to equity ratio is slightly higher than alpha's, indicating that beta company was 0.09 times more aggressive than alpha company's financing debit growth. As the result, alpha company has slightly higher risk in terms of term interest ratio. Alpha company has higher ratio of 23.41 times compared by beta company's ratio of 19.05 times, indicating higher ability to meet its interest obligations. Despite difference between two companies, two firms both are well positioned to cover their interest costs. As a result, both alpha and beta companies exhibit this higher solvency ratio positions with manageable debit ratio and the ability to meet long-term debit obligations. That's it. Thank you so much.
All right, thank you for that, Makshan. And my part is going to about last part of the financial ratio, which will be about efficiency, profitability, and market perspective. About the efficiency, assessing business efficiency involves looking at the key indicators like sales, account, receivable, and inventory management. So when comparing two companies, it's important to consider their specific industry and business characteristic. Alpha excels in accounts receivable turnover with a rate of 20.18 times, surpassing Beta's is 14.82 times. This suggests that Beta company may need to implement stricter rating policies. In terms of average collection period, Alpha collects payments in just 22 days, while Beta takes 24.63 days. This indicates that like Alpha is more efficient in collecting payments. Moving on to the inventory turnover, Alpha outperforms Beta with the rate of 7.70 times per year compared to the Beta's 4.91 times per year. Beta's longer inventory conversion period of 82 days versus Alpha's is 57 days. 57 days like highlights a need for the improvement in inventory management. It's worth noting that although Alpha's total asset turnover is slightly lower at 1.83 times compared to the Beta's 1.90 times, both companies exhibit like reasonable asset like utilization efficiency. Next page. About the profitability ratios are important tools for evaluating a company's financial health and efficiency. They provide valuable insights into how well a company can generate income from its assets. In the data, we have Beta company stands out in several aspects. First, it's boasts a higher gross profit margin at 33.04%, while Alpha company's margin is slightly lower at 29.99%. This indicates that Beta is more efficient in its industry operation. When we consider all expenses, Beta margin is an advantage with the net profit margin of 23.90%, whereas Alpha's margin is 21.06%. This demonstrates that Beta is more profitable overall. Looking at the return on total assets, which means pre-tax, Beta companies 45.49% outperforms Alpha companies is 38.46%, indicating that Beta generates some more income relative to its total assets. So, however, when we shift our focus to the return on equity, Alpha companies 64.96% surpasses Beta companies is 55.78%. This suggests that Alpha delivers high returns to their shareholders. It's important to note that factors like high debt financing may influence this figure. Next page.
Market prices play a vital role in guiding investors and analysts as they evaluate the company's future potential and driving insight from its current earnings. To gauge these prospects, they commonly rely on two key metrics: the dividend yield and price-earnings ratio. The price-earnings ratio offers a glimpse into the investor sentiment regarding profit growth, with the higher ratio indicating heightened expectations. For example, Alpha company boasts a price-earnings ratio of 16.63, signifying greater optimism among investors compared to Beta company's ratio of 13.70. Interestingly, despite these two differences, both companies present similar dividend yields of 5.07%. This similarity implies that investors can anticipate comparable dividend returns from both Alpha and Beta. However, it's important to note that Alpha is anticipated to exhibit a stronger profit growth, making it a potentially more lucrative investment, while Beta is perceived as safer, more conservative choices. Yeah, that's it.
My name is Liang. I'm a member of group number 7. Now I'm gonna present a recommendation and conclusion of our assessment. According to the above, we analyze two companies. We choose Alpha company because Alpha company's price-earning ratio is more potential and well positioned to attract lenders. So on this slide, some of the reason for choosing alpha companies. Move the next slide. Thank you. And some of the reason for choosing alpha company. Strong price earning ratio indicating future potential, efficiency and solvency metrics that attract lenders, and increased cash flow and funding potential, and strategic decision for broader customer base and operational efficiency. As previous slide, we can see two companies' profitability. Alpha companies' profitability is lower than beta companies, but alpha company is a good investment option more than the beta company. As a result of the comprehensive analysis for our assessment, firstly, alpha company price earning ratio indicating positive outlook for future performance and increase investor confidence. And lastly, alpha company's higher time interest earned ratio indicates its ability to generate sufficient cash flow and secure funding. For watching our assessment.
All right, thank you so much for
Thank you.
watching our presentation.
Thank you.
For your attention.